When I look at it, I actually think it's been doing a good job as digital gold if you look at it over the right time horizon, right? Over the last 10 years, the dollar is down 26% and Bitcoin's up 20,000%. That's pretty good. If you look since the COVID low, even today, Bitcoin is up 20x from where we bottomed at the start of COVID when inflation really hit. It's on these shorter term periods. And we can talk about why it didn't follow gold up at the end of the year. I have a very strong view there. But gold itself, if you've been studying gold for 10 or 20 years, goes through long periods where it doesn't do a perfect job storing value. You have to look over long periods of time. So I think the Bitcoin thesis is still intact. The technology still works. It's still the only digital asset you can self-custody through settlement.
It's funny how quickly short-term market noise can warp our sense of reality. A few sluggish months, a little underperformance against gold, and suddenly people start acting like Bitcoin's entire digital gold reputation is falling apart. But real stores of value aren't measured in weeks or quarters. Gold itself has had long periods where it failed to protect purchasing power, only to eventually remind everyone why it matters. Bitcoin isn't any different, except it operates in a market that's faster, louder, and far more reactive, where every tiny move gets amplified and every lull gets framed as a crisis. Bitwise CIO Matt Hougan brings the conversation back to first principles. According to him, when you pull back and look at meaningful timeframes, the view changes completely. Over the past decade, fiat currencies have steadily declined in value, while Bitcoin has gone through a massive repricing. Even if you start from the COVID lows, during a moment when inflation was reshaping the entire global economy, Bitcoin still multiplied dramatically. Compared to that arc, short-term divergences with gold barely register, and what truly sets Bitcoin apart from every other digital asset has nothing to do with hype. It's the design. It's the only asset you can self-custody, settle without relying on any intermediary, and independently verify whenever you want. That combination gives it a level of monetary credibility nothing else can match. The price may swing and steal the headlines, but underneath all that noise, the core thesis keeps strengthening, quietly compounding while the market chatter comes and goes. Let's watch more clips from Matt Hougan's explosive interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for tuning in. Enjoy the rest of the video.
I do think this is an interesting opportunity if you have a long-term time horizon, and I think we'll probably round to a bottom. But could it go further? Of course, I think the thing about when I watch the media talk about these big market moves is they try to pin it on one specific thing. My take is this is not a one specific thing move. I think there are 6 or 7 factors that are contributing to this all at once, and that's how you get these big sustained selling. So just to itemize then, some of it is OG crypto investors selling out of fear of a 4-year cycle. They sold maybe $150 billion in 2025. I think that started to taper off, but they have been right that the 4-year cycle would repeat, and some of them stepped out of the way. Some of it has been still the effects of the October 10th liquidation event. I think there's still rumors, I'm sure you were hearing them yesterday, of forced selling by one or more hedge funds or broker dealers that were impaired in that event. I think that is in the mix. I think some of it is concerns that Kevin Warsh, the new Fed chair, is more hawkish than some of the other people that were being considered for the Fed chair. I think some of it is the broader macro picture. People were selling Palantir and Amazon yesterday. They were selling silver and gold. They were also selling Bitcoin. I think it's when you put all those things together, you get this kind of sharp move downwards, particularly when those of us who are bullish long term. But we don't have a specific thing that we're pointing to, a Schelling point that we say it's going to be this, right? It's going to be the approval of the Bitcoin ETF, or it's going to be the emergence of DeFi. We're sort of reaching for that narrative. And so I think it's all of those factors at once. But it was a big shocking move yesterday. Fear and greed went to the lowest level, I think, in history. So maybe that starts to form a bottom. I guess we'll see. Amongst all the things, actually, that 5 reading made me the most optimistic. I look for asymmetric trades in my life, and that is just an asymmetric chart, right? Yeah, could it go from 5 to 4? I guess, but 5 can also go to 100. And so I think when you think about where we are in the market, that fear and greed index is actually a good place to start. It is really all the way floored on the fear side, and that does create some asymmetry if we start to get more positive or more balanced news. So that reading made me pretty happy yesterday. So my core thesis on Bitcoin is digital gold. I think it's better than gold because it extends self-custody through settlement. I think gold is good as a store of wealth, but as we move into a multi-currency world, the ability to use it to settle transactions is really challenged by its physical girth. And Bitcoin solves that problem. I think the Bitcoin thesis is still intact. The technology still works. It's still the only digital asset you can self-custody through settlement. And that is a very powerful thing in a world that's losing faith in institutions. I still think that's intact. But yeah, maybe I can talk about why gold rallied and Bitcoin didn't.
Yeah.
The thing about the gold rally is I actually don't think it was a debasement rally. What I think happened was that in 2022, the US seized Russia's treasury assets and central bank purchases of gold went up 150%. So actually they had been buying about 400 tons of gold a year. And in 2022, they bought 1,000 tons. And then in 2023, they bought another 1,000 tons. In 2024, they bought another 1,000 tons. In 2025, they bought another 1,000 tons. So it did a one-time uptick because central banks learned that if you held US treasury assets, they could seize it if they wanted to, and they didn't like that. That obviously doesn't apply to Bitcoin because central banks don't hold Bitcoin by and large. It's not yet big enough, but that's what drove gold. The interesting thing about that, Miles, is that the price of gold didn't go up in 2022. So central bank purchases went up, but the price of gold went up like a couple percent. And then the price of gold went up like 11%-ish in 2023. And it did a little bit better in 2024. But yeah, you're highlighting it. The central bank purchases increased, but it took 4 years for it to work through excess supply. So for those first 4 years, people were willing to sell into the market and central banks kept buying. They were willing to sell into the market. What happened in 2025 is that people ran out of gold to sell. And so as central bank buying persisted and the available supply sort of exhausted itself, the price has nowhere to go but parabolic. I actually think long-term, the same thing is happening in Bitcoin. If you look at ETFs on a 1-year basis, I know there've been outflows over the last few months, but in 2024, ETFs bought something like 2x the supply of Bitcoin. In 2025, ETFs bought another $20 billion of Bitcoin. That was more than the available supply. That chart is going up quickly. And from my conversations with institutions, it's going to go up again. I was at meeting with financial advisors this week in South Florida. Yeah, exactly. They are still very interested in Bitcoin. Many of them see this as an entry point, a new time to get in. People who bought it previously are going to continue to hold. So ETFs are going to eventually exhaust the supply of Bitcoin the same way gold eventually exhausted the supply. It just takes a while. So look, when I look at the gold move, I say the store of value market is bigger than it's ever been, and Bitcoin is eventually going to win a huge share of that. I think that's still intact. I don't think people should give up the faith. The challenge for the market right now is that the positive stories are very slow. So the next cohort is still financial advisors. It's wirehouses like Morgan Stanley, it's family offices, it's insurance companies, and it's sovereign nations. I'll give you 2 facts that to explain why it's still that story, why we haven't even really seen the impact. This is the market that we serve at Bitwise. This is how we've gone from nothing to $15 billion of serving this market. Our average client allocates with us after 8 meetings. In other words, either me or one of our 25 salespeople or our research team has to go meet with these clients 8 times on average before they allocate. In general, we don't meet with people more than once a quarter. So 8 times is 2 years. That's how long it takes for these traditional financial executives to get their heads around Bitcoin. I raise that because we haven't even really seen the flows, right? We've seen the initial flows into Bitcoin ETFs from people who were already familiar with it. But the people who are starting at zero, 95% of those people are still just now getting involved. And the way this market works is that on the first day of Bitcoin ETF launch, only a small fraction of the institutional market can buy it, maybe 10, 15%. If you're a financial advisor on a big platform like Morgan Stanley, they just approved it in Q4 of 2025. So their 8-meeting clock just started a few months ago. They're going to be allocating in 2027. And this, it's obviously different people come at different times. This is an average, not individual, but this is going to create a rolling wave of inflows.
What looks like panic is really pressure finally releasing all at once. A handful of forces collided, older holders stepping aside, macro worries intensifying, policy signals turning messy, and forced sellers hitting the market, triggering a sharp emotional reset. Moves like this feel chaotic in the moment, but they often clear the air rather than poison it. Extreme fear usually appears near inflection points, not final chapters. When dominant narratives crack and conviction starts to shake, long-term structures take over, quietly laying the groundwork for the next asymmetric opportunity. According to Matt Hougan, this moment isn't about panic as much as it's about patience. Big capital doesn't rush. It moves through slow cycles of learning, internal debate, and risk management, not viral headlines. Short-term fear can mute demand and distort price action, even when the long-term trajectory hasn't meaningfully changed. And as Bitcoin matures, it draws regulation into its orbit while simultaneously creating room for privacy tech, DeFi innovation, and asset tokenization to expand. What feels like fragmentation is really broadening, adoption spreading outward and upward on timelines measured in years, not weeks. Let's watch more clips from the interview.
The closest analogy to this was the gold ETFs, which launched in 2004. And when the gold ETFs launched, the first year inflows was something like $3 billion. And it was the second biggest ETF launch of all time. And everyone was excited. But the second year inflows was $5 billion. And the third year inflows was 8. And then it was 10. And then it was 12. And then it was 18. It actually took 8 years to reach the first peak of inflows. And then it fell a little bit. And actually on the 18th year was the peak to date. In terms of inflows. The TradFi market just moves extraordinarily strong. So I raised that by saying most of the world's capital is controlled by professional investors. Most of that money doesn't own Bitcoin yet. I think eventually it will, but that takes just an enormous amount of time, right? It takes an enormous number of meetings, an enormous amount of education. But make no mistake, from my channel checks, from our internal flows, it's still happening, and I think it'll happen for years to come. I think it's a little bit of an issue. So it does get raised in my meetings, particularly with larger institutions. It is a reason for them to say no. Sometimes they're just looking for a reason not to do it because they don't feel comfortable with it. And if they can point to something like quantum, then that is a reason to delay making that decision. I think it's keeping them out of the market. For what it's worth, I also think usually in these market pullbacks, one of the sources of support in Bitcoin is sort of the OG Bitcoin community. And I think when you have Willy Woo worrying about this, and when you have Castle Island worrying about this and Nick Carter worrying about this, part of that OG community is uncomfortable coming in until Bitcoin core devs make this a thing. I think tangible progress on quantum resistance would actually be one of the signals that could help us bottom. Now, do I think it's a pressing problem? I don't think it's a pressing problem. I still think it's many years out. Do I think Bitcoin can solve it? I think Bitcoin can solve it. We know what the problem is. There's some uncomfortable decisions we have to make with things like Satoshi's wallets, but it is a problem that we can identify and solve. But absolutely, is it coming up at the institutional level? Yes is the answer. I met with a central bank earlier this year. They raised the question of quantum. and telling them that we know it's a problem and that there are solutions in the future, they can say, great, but you still have to implement those solutions, right? And there's always a risk in implementation. So I do think this is one of the things that could help us bottom and be a positive catalyst. It doesn't matter if I'm worried about quantum, right? It doesn't matter if I think the devs will solve it. It doesn't matter if like I'm feeling it matters what the community thinks, because as you said, it keeps some of those OGs on the sideline. It skews the book. It removes a source of support, and it can spiral. And, I mean, you can look at the relative returns of an asset we haven't talked about, and this is not the only reason it's been more resilient, but Bitcoin Cash versus Bitcoin, since they got on the quantum warpath, it's outperformed. I may not like that, but it's just objectively true. And I think the data in the market suggests what you're saying is true. This is keeping part of the OGs out of the market. It's probably encouraging them to sell. And it doesn't matter if it's a real concern or an immediate concern or not. It has to be solved to help with that relative narrative. But I was looking at the other day at monetary crypto assets. And if you plot since, let's say, the start of 2025, if you compare Bitcoin, Bitcoin Cash, Zcash, and Monero, I think it tells a pretty interesting story, which is that there's part of the OG crypto community that I think is worried about Bitcoin and quantum, that is worried about sort of suit coins like me dragging Bitcoin into the regulated market, and privacy coins, and maybe with Bitcoin Cash's sort of tilt to quantum resistance in the middle or part of last year. There's been a little bit of rotation there, right? I think it's an interesting side note. Again, I think Bitcoin wins in the end. That's my core thesis, but the numbers suggest something interesting is going on. I do think one sort of picture you can have in your head is that as Larry Fink and other traditional investors drag Bitcoin into the regulated sphere, it creates a much bigger space for actual privacy coins on the other end of the sphere, where they won't participate in the same way in the institutional market. Like, I would be very challenged to bring a Monero project to market. It just wouldn't sit well with regulators. But that is a significant community. And I think, again, as we move crypto more mainstream, the space for that widens out. And I think, when I talk to that part of the community, they are excited about those markets. My base case is that all of finance will move over blockchain-based rails, but we're so early in that process. What is RWA? It's like $25 billion. We're so early in that process that anyone who tells you, I know exactly how it's going to be, is lying, right? To put this chart in context, there's $110 trillion of stocks, right? There's $150 trillion of bonds, or maybe $200 trillion. So this is like 0.01% penetrated. And I do think there's a chance that this market wants more privacy associated with it. And I'm bullish on those projects because I think it'll be years before we know. And in the meantime, they have a legitimate shot on goal. I think it's bullish for the L1s, but I think that's pretty well understood. Like, I think it's bullish for Solana. I think it's bullish for Ethereum if they execute well. But I think the most interesting and overlooked side of it is, I think it's dramatically bullish for DeFi. Really, the killer app of tokenization is not faster settlement, right? It's actually not that my father is sitting with his Schwab account and frustrated that it's T+1 settlement. That's like a minor frustration. The first thing people do when you have tokenized assets is they borrow against them, lever themselves up, margin them, loop that leverage, et cetera. That may be good or bad, but that is what people do. They use tokenized assets in DeFi. And so if you think about a world where we have $200 trillion of tokenized assets, and everyone in the world is walking around with a wallet where their assets are tokenized, I think the volume of lending and borrowing is astronomically higher than it is today. I think the number of people providing liquidity or taking liquidity off markets is astronomically higher today than it is today. So I think well-organized DeFi projects particularly they get their tokenomics right, have an opportunity to scale like 100x as tokenization becomes a thing. They're the real 100x beneficiaries. ETH and Solana may be 10x beneficiaries, but they are the like 100x opportunity if you can find the right ones.
Bitcoin hovering near $70,000 has felt unsettling to many, especially after a brutal sell-off that cut prices nearly in half from last year's peak. Forced liquidations, whale selling, and sharp daily drops revived memories of past crypto winters. Yet beneath the volatility, little has actually changed. ETFs remain intact, institutional infrastructure is still growing, and even after the chaos, Bitcoin stabilized quickly. That kind of resilience matters. When price falls faster than fundamentals, markets often misread what is really happening. This framing lines up closely with what Matt Hougan has argued about Bitcoin's role and behavior. Short-term price action can look ugly, but it rarely defines the asset's long-term trajectory. Analysts calling the recent move a crisis of confidence rather than a structural failure echo that idea. Nothing broke. Adoption did not reverse. ETF outflows have been modest compared to the size of the drawdown, suggesting conviction is wobbling far less than price implies. Even concerns around quantum computing are being treated as distant, manageable risks, not existential threats. What makes this phase interesting is timing. Bitcoin is no longer a fringe asset, but it is still early in its institutional absorption. That creates an awkward middle ground where volatility remains high while foundations quietly strengthen. Some investors are already leaning back in, increasing exposure while leaving room for more downside. That balance reflects a growing maturity in how Bitcoin is approached. The noise is loud, but the signal points to something else, a market digesting fear, not unraveling, and setting the stage for what usually comes after confidence returns. As we wrap up, do you think this sell-off reflects real weakness or just shaken confidence? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching. Don't forget to like and subscribe.